What if I told you one of the world's biggest companies just posted its weakest profit in nearly 5 years, but is still handing out billions to shareholders? This is Kenya News Update today. Coming up, you'll discover the shocking numbers behind Shell's latest earnings, why this is a seismic shift for the entire energy industry, and what it means for your wallet and the global economy. Meet Shell, a British oil giant, a global energy titan. For decades, its profits have been a barometer for the world's economic health. But on Thursday, that barometer broke. Shell reported adjusted earnings of just $3.26 billion for the fourth quarter. That's its weakest quarterly profit since early 2021, and it missed analyst expectations. For the full year 2025, the picture was just as grim, $18.5 billion in profit, down sharply from $23.72 billion a year earlier. But here's the twist. Despite this massive profit slump, Shell is doubling down on shareholder payouts. The company announced a 4% dividend increase and a massive $3.5 billion share buyback program. That marks the 17th consecutive quarter of buybacks at $3 billion or more. I'd start off by saying it was actually a very strong operational quarter for us, said Shell CEO Wael Sawan in an interview. A few things hurt us this quarter. Number one was some tax adjustments which went against us. Chemicals has indeed been weak, but I would look to the strength actually of our integrated gas, upstream, and marketing businesses. But here's what nobody's talking about. This isn't just a Shell problem. This is a crisis for European energy majors. Lower oil prices are forcing them to confront some brutal choices. And then something shocking happened. Norway's state-backed energy company, Equinor, announced it was slashing its share buybacks to $1.5 billion this year, down from $5 billion last year. They're also trimming investments in renewables. Shell is choosing a different path. They're keeping the money flowing to investors, but at what cost? The company's net debt ballooned to $45.7 billion at the end of last year, up from $41.2 billion just a quarter before. Their gearing, a key debt ratio, jumped to 20.7%. Here's the part that will blow your mind. In a weaker profit environment with rising debt, Shell is still prioritizing shareholder returns over everything else. Importantly for investors, Shell continues to prioritize shareholder returns, said analyst Maurizio Caroli. The company has confirmed a further $3.5 billion share buyback for the first quarter, even as some other European oil majors have opted to scale back distributions. This creates a massive controversy. Some say this is smart capital discipline, rewarding loyal shareholders during a tough time. Others see it as a dangerous gamble, propping up the stock price while the company's financial foundation weakens. The strategic question is huge. How does Shell replace its oil reserves for the future? Through organic development or by buying other companies? The answer will determine its survival. The impact is global. For Kenya and every nation, the health of oil giants dictates energy prices, investment flows, and economic stability. When a titan stumbles, the whole world feels the tremor. Shell's shares traded 1.4% lower on the news, but the stock is still up about 3.6% for the year, perhaps buoyed by those very buybacks. So what's the real story? Is this a temporary blip or a sign of a deeper industry collapse? Is Shell's strategy of payouts over prudence a masterstroke or a mistake? Do you think a company should pay shareholders billions when its profits are crashing and its debt is rising? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking global news that hits home.